Private equity, PE, and venture capital, VC, are two types of investment vehicles that play critical roles in funding businesses at different stages of their growth. Let's dive deeper into these areas. 1. Private equity, PE, definition. Private equity involves investing directly in private companies or taking public companies private through buyouts, with the goal of improving the company's performance and eventually selling it for a profit. Key focus. PE firms typically target mature companies that are underperforming or have growth potential. They buy a significant stake, improve the company's operations, management, or market position, and eventually sell the business at a higher valuation. Types of private equity investments. Buyouts. Acquiring control of a company, often with leverage, LBO. Leveraged buyouts, restructuring the company to increase value. Growth capital. Investments in more mature companies needing capital to expand or restructure operations. Distressed investing. Acquiring companies in financial distress at a low price, restructuring them, and selling for profit. Exit strategies. PE firms aim to exit investments through initial public offerings, IPOs, taking the company public. Mergers and acquisitions, M&A, selling the company to another firm. Secondary sales. Selling to another PE firm or institutional investor. Current trends in private equity. ESG-focused investments. PE firms are increasingly looking at environmental, social, and governance, ESG, factors when making decisions. Tech-focused deals. The tech sector is a growing focus for PE firms due to its high growth potential. Roll-ups. Combining smaller companies within the same industry to create a larger entity with greater market power. 1. Venture capital, VC, definition. Venture capital is a type of private equity focused on investing in early-stage startups with high growth potential. VCs provide capital in exchange for equity and often play an active role in guiding the company's strategy and operations. Key focus. Unlike PE firms, VC firms invest in young companies, usually startups, that need capital to scale. These firms are riskier investments but offer higher potential returns. Stages of venture capital funding. Seed funding, the earliest stage, helping startups develop their product or service and gain initial traction. Series A, B, C funding. As startups grow, they seek subsequent funding rounds to scale operations, expand teams, or enter new markets. Late stage VC, larger, more established startups, unicorns, that are looking to solidify their position in the market and potentially prepare for an IPO. Exit strategies. VC firms aim to exit through IPOs. When a startup goes public, VCs can sell their shares at a significant profit. Acquisitions. Many VC-backed companies are acquired by larger companies, providing liquidity for investors. Current trends in venture capital. Tech and AI-driven startups. VCs are heavily focused on technology, particularly companies in AI, fintech, SaaS, software as a service, and healthcare innovation. Global expansion. VCs are increasingly looking beyond Silicon Valley, with growing interest in emerging markets in Asia, Africa, and Latin America. SPACs, Special Purpose Acquisition Companies. These vehicles are allowing companies to go public quicker and have gained popularity among VCs as a potential exit strategy. 1. Key differences between PE and VC stage of investment. PE focuses on mature companies, while VC focuses on startups. Investment strategy. PE uses buyouts and large equity stakes to control companies, while VCs typically invest in minority stakes and help guide early-stage companies. Risk and return. PE generally has lower risk but offers more stable returns, while VC is high risk, high reward. Time horizon. PE investments usually have a longer time horizon, often 5-10 years, while VC firms often exit after 3-7 years. 1. How PE and VC create value. Private equity focuses on improving operations, cutting costs, streamlining management, and expanding product offerings to increase profitability. Venture capital emphasizes innovation, product development, and market expansion, often taking hands-on roles with startups. 1. Firms in PE and VC. Top PE firms. Blackstone, KKR, Kohlberg Kravis Roberts. The Carlyle Group. Top VC firms. Sequoia Capital, Andreessen Horowitz, Excel Partners. 1. Challenges and opportunities for private equity. Rising competition for deals and increasing valuations can drive down potential returns. Regulation and compliance challenges in cross-border investments. New opportunities in sectors like healthcare, renewable energy, and technology. For venture capital, startups are staying private longer, making it harder for VC firms to find exits. Increasing competition means more VCs are fighting over promising startups. Opportunities in the digitization of traditional industries and emerging markets. Private equity and venture capital offer different approaches to generating returns, but both play a crucial role in fostering business growth and innovation. Are you looking to explore one of these areas in more detail, such as starting your own investment fund or targeting specific industries?